Let's bring in Ryan Belanger, managing principal and founder of Claro Advisors. It's good to see you, Ryan. And maybe it's because there's still a decent amount of time to go, or maybe because a ton of people want to buy this event and therefore it's somehow not going to happen.
Yeah, I don't think it's going to happen. I mean, the United States has raised the debt ceiling almost 90 times since the 20th century began, and 16 in the last 20. In my view, this is political posturing. It's gamesmanship. It's something that must be done once in a while. It's no different than parents telling their kids that Santa Claus won't come if they don't behave a little bit better. In my opinion, I think the debt ceiling will get raised, and it's just a matter of if, not when. The outcome is obviously very severe and something it's just hard to plan for, but there's no way they're not going to raise this debt ceiling. And right now, both political parties are acting in their own self-interest. And my hope is that at some point they come together and put the country's best interest first.
Yeah. I'm trying to think through the Santa analogy because I can control what Santa brings, right? You know, and who's Santa? Well, I guess the point is this. If there really does need to be some negotiation between Republicans and Democrats over spending for, let's say, the next year or the next couple of years, what are going to be the other opportunities to do that? There's the debt ceiling. I guess at some point, is this all going to get rolled up into a discussion about government spending broadly speaking? Could the risk of a shutdown as well be looming again as we move throughout the calendar year?
You're probably right, Kelly. I mean, look, the debt ceiling was put in place for a reason. It was put in place, back in the early 1900s. You got to have a spending limit. So there's a reason it exists, and it just kind of perpetually gets kicked down the can gets kicked down the road until some modifications are met. And I think that's what's going to happen this time. There'll be some concessions on both sides. Ultimately, they'll put the strength of the U.S. dollar and the reserve currency of the world ahead of the political persuasions that are negotiating these things, and that'll be a good thing for investors. Right now, they're just concerned. What does this mean? And to us, it doesn't mean that you change any of your investment allocations. I think you've got plenty more to worry about in this economy.
So, Ryan, it's Dom. Speaking of those things to worry about, that even if you don't make wholesale portfolio changes because of debt ceilings or government shutdowns, there is still a general risk sentiment that you have to position for. What exactly is your portfolio tilted towards right now, and what exactly are you overweight or buying more of?
Well, we're probably more overweight in bonds than we have been in a long time. I mean, the bond math is great. Getting yields of close to 5% or more. You just haven't had that opportunity in a long time. Savers finally can earn something in a money market. Hopefully they're in a money market. I mean, a lot of people are still sitting somehow in cash in a bank. That's just the easiest thing to do, is to get your money into a money market, ladder some treasuries, get some yield. But you can't give up on your stocks. I mean, stocks over the long term are the best long-term creation of wealth that we have. And so, in my opinion, you keep your stock allocation. You probably want to reduce it just because there are a lot of headwinds, that we see. So you're probably on the lower end of your equity range, and you're liking the income you're getting from your bonds.
So, Ryan, on the question about bonds, I mean, is this going to be a one-time sale, so to speak, that again, if you look at some of the yields that you can get, they're really good for 1 month. They're pretty good for 6 months. They're a little less interesting for a year. They're a lot less interesting for 2-3 years. I just wonder, are people going to have as good options in maybe 3, 6, 9 months' time when the reinvestment time?
Well, it's a great observation, Kelly, but in my opinion, the 75% probability that we get a rate cut by September is ludicrous. I can't believe that's what the curve is suggesting. So in my opinion, investors are going to continue to get opportunities to roll their credit at 4 or 5% come fall and winter, and that'll be good for a lot of investors. I think that the yield curve is just pricing in something that is unattainable at the moment, and that's a rate cut. I just don't see that happening.
All right. T-bill and chill has some legs to it. Ryan, thanks so much. It's good to see you today. Ryan Belanger.